Today, I want to talk about mortgages. And the reason why is because in the last week, Trump floated possibly one of the dumbest things I've ever heard, and that was the 50-year mortgage. Now, if you don't know, what we have right now is we have a 15 and a 30. And the reason why a 50 was floated is essentially affordability. But the thing about the 50-year mortgage is that it would not really address this problem at all. What I want to do is I want to take a look at a video where they did a very good job breaking down what the actual numbers look like and why it makes no sense whatsoever. And then I will discuss as well what are the actual drivers of this unaffordability and what I think need to be done to actually deal with it. So let's get into it, and then I'll give my feedback on top of it.
What's up, guys? It's Graham here. So this is absolutely crazy. Over the weekend, President Trump tweeted the idea of creating a 50-year mortgage as a way to help lower payments for people who want to buy a home. And I know I might get some pushback for saying this, but to me it's obvious. A 50-year mortgage is an absolute disaster waiting to happen, and no one should ever take that option. Ever. In fact, a 50-year mortgage is completely uncharted territory.
And the thing is about that, and this is why I wanted to cover this topic, is because just immediately hearing 50-year mortgage, I said, yeah, this makes absolutely no sense. If you think about it, right now, the average age of a first-time homebuyer is 40 years old. And it's just going to continue to go up and up and up the longer that this problem is unaddressed. And so just think about that logically, just mathematically, simple addition. What is 40 plus 50? Like, even not understanding the numbers of like interest and how that actually affects the cost of the loan, how much interest you're paying over the life compared to a 30 to a 50. Just think simple addition of years. First-time homebuyers are 40, and it will not be paid off for 50 years. Does that make sense at all mathematically? That means the average home buyer will be 90 years old by the time they pay off this house. And I don't know if life expectancy has just drastically increased, but pretty sure people don't typically live to 90 years old. That is an outlier. And so And also, they're not working that entire time. So they're continuing to pay and pay and pay. So they're paying out of their Social Security, or they're working longer, or what is actually going on here? So just taking a look at that just right off the bat, when I heard it announced, just simple addition. I mean, to even pay it off before you are statistically likely to die, you would have to buy a home as soon as you're out of college, pretty much. And so, yeah, it just made no sense from the get-go. But like I said, when you actually dig into the numbers, it's much worse than that.
And if one thing goes wrong, it could completely devastate both the housing market and the borrower. So let's talk about the actual math behind getting a 50-year mortgage, if and when it ever makes sense, and my own thoughts as someone who's been in real estate since 2008. Because I gotta say, most people have very little understanding with how this works and why it's a really, really bad idea. Although before we go into that, if you appreciate videos like this, where we just cover the facts, it would mean the world to me if you mortgage the like button or refinance the subscribe button for the YouTube algorithm. It helps out tremendously, and as a thank you for doing that, here's a picture of a baby polar bear. So thanks so much, and also big thank you to Helium Mobile for sponsoring this video, but more on that later. Alright, so to start, let's talk about where all of this begins. The 30-year mortgage. For those unaware, this was initially created in the 1940s as a way to help finance the construction and sale of new homes after World War II. And then by the end of the 1950s, it was adopted throughout the entire market as a way to incentivize families to build long-term equity. Well, wouldn't you know it, these days, the 30-year mortgage has become so popular that more than 90% of buyers pick a 30-year term on their mortgage. Now, obviously,
and here's the thing about this, before we even get into any of the math of it, right? It makes sense that yes, okay, they needed that to kind of finance it over a longer period of time. But just like school loans, the problem with it in general is that it just ramps the cost. Like, if you did not provide any sort of financing, the price on it overall would just come completely down. Like, financing and mortgages and loans and credit cards and all of these things are just it destroys the American public in essence, because what it does is it provides, instead of saying, okay, you can go out and you can buy a house with 3 years paycheck. Well, now it doesn't matter as long as you can continue to afford paying for it. Well, now we can drag this out over 50 years in what is being pitched here. But that's the exact thing, is that it doesn't make any sense at all. But if you were to take away all financing, well, now all prices have to come drastically down, because otherwise no one will be able to afford anything. And then, oh, we can only charge what people can afford, because otherwise there's just tons of houses sitting around with no one in them. And so that's exactly it. That's the thing, is yes, it is probably better because it provides a long-term, if there are people who are not able to put away that amount of money because they are living more paycheck to paycheck, okay, they can get in and they can have some sort of, instead of paying rent, now I'm paying for the house, and that's built into my monthly instead of, trying to scrape together money and then buying it all at once. But I can tell you, the housing prices would come way down if they removed any sort of mortgages, loans from the market in totality. Like, make no mistake, they would come way down. But yeah, understandably, once again, that yes, for the general public, it makes it much more accessible for everyone to be able to get into the market and own a home, or at least a much greater amount of people, until you get to where we are now, where it's just a runaway freight train and prices are just going up, 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 and they don't stop.
Obviously, there are more options today for buyers to pick from, like an adjustable rate mortgage, interest-only mortgage, 15-year terms, and so on. The options are pretty limitless, but the 30-year term is often seen as the safest. It offers the most flexibility, the most stability, your price is fixed until the home is paid off, and if you qualify, they're pretty easy to get because almost every bank offers them. However, there is a bit of a catch, because your interest payments are front-loaded towards the beginning of the loan. For example,
and that's a very good thing to call out. And especially in today's age, where people are moving more frequently. Like, how many people do you know that have stayed in their house for 30 years? I'm actually an anomaly in this case, because I have stayed in mine, I think I'm like 7 or 8 years now. And even then, I actually refinanced, I think 2 years in, because the housing prices went on a wild run, and I had mortgage insurance because I had paid, I think it was like 10 or 15% down, because I have enough that I can put it down and still get the interest rate that was lower, but then also the interest rates dropped as well. And so what I did was I just refinanced the amount, right? And then said, okay, well, the house is like double in value, so it doesn't really matter. Like, I'll just take out, refinance it, not take out a new one, but I'll just refinance it. And then the mortgage insurance fell off completely, and it was a lower rate, not insanely lower, but a lower rate anyway. And so again, I just kind of lucked out that that's what it was. So even then, the length of my loan is like 5 years instead of 7, which is the amount of time that I've been in the house. But the thing is, like, okay, I've been paying off extra because knowing that, and we'll go back to that chart here. And so if you go back and you look, yeah, 100% though, like, you're not paying off, like, you're paying off some principal, right? But then the issue is, because the banks want to make sure that they're recouping all of their costs, right? They want to make sure that they're getting paid. What they do is they front load the beginning of that loan with most of the interest. So you're barely paying off any. So the smart thing to do is if you're able to pay a little bit extra each time, that's how you actually build up a bunch of equity in the house. Or the price of the house, just like in 2020 time frame, it just goes on a wild run, and then you're just riding the equity of it flying up. So that's basically, if you know anything about it. But the thing is with that is, by doing that with a 50, you have to imagine that it's even more stretched out. So you're paying more interest over a longer period of time. And then if it's not like a convertible or something like that where you can take it with you, well, then you're continuing to pay that, you're just resetting every single time. And you're just treading water. And you're never actually building any sort of equity into it. Because if you go and move, guess what? That all gets wiped out. Like any sort of equity that you may have been putting into it in those payments over the time frame. I think the average is like people stay in their homes for like 6 or 7 years. Well, as soon as you move, well, you have closing costs, you have realtor commissions, you have to do repairs on the property, you have all these things that you typically have to pay for, all comes out of that equity. So you basically have gained nothing from it. And so that's the thing, once again, about spreading it out over a longer time frame, is the percentage of time that the interest is larger, that's going to last longer. And so you have to stay in the house for a longer period of time to make it worth actually taking out the loan and, okay, I'm starting to put in equity, and you actually start to make anything off the house. Unless you're just betting on, okay, I'm going to peg myself in at a price, and then the price of houses are going to continue to go up. But even then, you never know, because if at any point in time they say, hey, private equity, you have to get out of the market, well, then housing prices are going to come crashing down, and then you're sitting upside down on a mortgage that you're continuing to have to pay. And just like in 0809, a lot of people just walked away from them because it makes no sense, because you're paying this huge price when it would actually be cheaper to walk away. And then, you destroy your credit. So like you can't actually, take out another mortgage if you do this. But what you do is in theory, you could just walk away, go to a new house where the price has collapsed basically, and then take out a new mortgage, and then you're paying less, and it's like a hard reset on it. So that is the thing, is like when things like that happen, and who knows, that should, and I cross my fingers, because that's what I kind of want to happen, to bring the market back into an actual common sense place. But right now, yeah, the prices are so inflated that, again, if you're locked into it for such a long period of time as well, it makes it like quadruply, quintuply awful of a scenario. Because yeah, if anything happens where there's a correction, you're screwed, like completely screwed.
Loaded towards the beginning of the loan. For example, with any fixed rate mortgage, your monthly payment is split into two parts: principal and interest. In the beginning, most of your payment goes towards interest because you still have the full loan balance, and so very little of your monthly payment actually pays down the loan. But as time goes on and your loan balance gets smaller, more of that payment begins going towards principal. And over
As a point that I would like to make, how scummy is that? Like, I think it should, in my opinion, it should just be the whole thing is even. Like, if you're not confident that I'm going to pay out the entirety of my loan, then you shouldn't give me a mortgage to begin with. And so, yeah, I get it, right? Because just like I had pointed out, if someone moves, well then yeah, of course, they're not going to pay you as much interest. And that's exactly why they do it, because people don't typically stay in their homes for 30 years. So they want as much money as possible on the front end of that loan. But at the same time, once again, like I said, that screws you over, because you're not building equity, because you're not paying as much interest on the front end like you should be. And so, yeah, it's just a scummy practice to begin with. And that's exactly why I think, once again, to what I was saying, they should honestly just completely get rid of them. It would be a healthier model, because then it's, oh yeah, the prices come significantly down. There's less competition for them, so the prices have to come down. And then, yeah, you're just, here's the money. This is for the house, and end of transaction. I'm not, because they're incentivized to make the most amount of money, and so that's exactly what they're doing. Is they're saying, you give us all the interest at the beginning, and then eventually, when it gets to like 20 years, well, then you can start actually putting money towards paying down the loan. And it's just, I think it's disgusting. I'm not sure how you can argue against it, but that's the system that we have.
Time, you could finally start building equity. Like, this chart really shows it perfectly. As you could see, at first your monthly payment consists of almost all interest, but by the time year 20 comes around, this flips to the point where most of your payment becomes equity. And that's where things get very interesting. See, the tip.
And that's exactly what I was saying, right? Until year 20, I mean, yeah, it starts to kind of, it gets more and more and more the principal that you're paying, right? So it's a gradient. But yeah, at the beginning, if you're not staying in it for at least 10 years, there's nothing. Like, you're literally, it's as good for you to just go out and rent, essentially. And so unless, once again, the prices skyrocket up and you are lucky enough to buy before that happened. But again, there are fair arguments on both sides. I do think that people should be able to get in who are not able to be able to put away that much money, but it's trade-offs, right? No matter what, there's positives and negatives to both situations that I advocate for.
A typical person only keeps their home for an average of 12.3 years, meaning.
And there, okay, I was slightly off, but yeah, same thing. They don't even make it to that break point, right? So even if you're there for 12 years, 12.3 years, you're still not really biting into where you're getting that equity into the house. And that's why I say it's gross when the banks are charging all the interest up front, is because it should be straight line. Like, if that doesn't fit your model and you don't think that's fair, then don't offer a 30-year mortgage. Just say, okay, here's a 15. So that way we know that we're going to recoup most of our costs, because you're going to stay in there for 12, right? 12 and a half. And so, yeah, that's just where, if the rules are not, if you as a bank don't think that the money that you're getting for, I guess, taking on liability is fair with a straight line method, then don't offer a 30-year mortgage. I don't know what to tell you. Like, you're not actually doing anything anyway. It's a financial market, and okay, yes, there's some with like processing, and there are some costs to the bank, but like, transactionally, you're doing very little. Like, you're not adding anything to this process. And so that's where it just, again, this is just my opinion. You can think I'm totally wrong. Again, I see arguments on both sides, but when a bank is doing this, it's just like, come on. It to me, it just, I don't know how you can see it and not think that it is a corrupt system and very anti-consumer, in my opinion.
On a 30-year loan at 6% interest, they've barely begun to pay off their mortgage by the time they sell the home, get a new loan, and start the process over again. Even if they kept the home for the full 30 years, they will have paid $1.2 million to buy that $600,000 home 30 years earlier. So why don't more people go for the 15-year mortgage? When you look at a 15-year mortgage, you're going to notice that your monthly payments are significantly more expensive. And here is a real example of a $500,000 house, 6% interest, 20% down. If you pick a 30-year mortgage, your monthly payment's going to be about $2,400 a month, and a lender will qualify you for that payment if you make about $7,500 a month, or 3 times the mortgage payment. Pretty simple. However, if you get a 15-year mortgage, your monthly payment's going to be about $3,300 a month, which is going to require you to have an income of $10,000 a month in order to qualify. So what do most people do? That's right, they choose the lower priced option. It allows them to qualify with less income. It allows them to qualify for much more home. And that's the positive
argument, right? In my opinion, is that it does, and I mentioned it earlier in the video, but it does allow people who do not have as high of income to say, hey, we need the space. It's a viable option to go from renting to, okay, we can theoretically get a house. Like, it's actually physically possible that we could do this. And that is exactly it. When you're looking at it, that is the positive, is it doesn't just keep people permanently in apartments. Again, the housing prices would come significantly down, but then that would also preclude a certain level of the population to be totally unable to afford houses. So overall, it's probably better that we have a 30-year mortgage, but again, I can make arguments on both sides.
Things being equal, they would be able to increase their purchase price by 34%, which is a lot. Like, that's the difference between you buying a $500,000 home and a $670,000 home. And even though, sure, with a 15-year mortgage, much less of your payment is being eaten away by interest, for most people, the 30-year option offers more flexibility, it's easier to qualify for, they could get a bigger house, they have more options, and so they go for it. That's why most people think, oh, a 30...
And when I was in finance, I took finance in college, personal finance, that was what the professor actually said, is even if you can afford, and I thought this was very good advice, even if you can afford the 15, you always take out the 30, because you never know when your situation is going to change. You may get laid off, you may have, whatever it is, something could happen, but it's much more affordable. And especially, I like the way that he lays it out here, and this is why I wanted to show his video and talk about it here, is because he lays it out and says, oh yeah, you have a 34% increase on the amount that you can actually qualify for with the same take-home paycheck. And once again, allowing that flexibility, I think, is a good thing, right? And that's, once again, why I like how he lays it out here. And the point that, back to the finance professor, the thing that he said is, oh yeah, you take out that lesser amount, and then exactly what I do, if you can afford to pay more than that, you do that. And so you are paying down proactively. You're taking a look at your actual situation, and you say, okay, how much more can I actually pay this down? And that's been something where when I have more money, I pay more, right? I'll double the payment of how much my mortgage is on a monthly, and then when I need to tighten the belt or something, well, then I can drop it down, and then I pay $100 more than whatever my mortgage payment is. And that's exactly the thing, is that it allows you that flexibility where you're saying, okay, I'm feasting, I have a ton of money coming in monthly that I don't need to worry about, and I can pay way more above that, the monthly payment, so that it can all go into the principal, right? So I'm actually building equity much faster. Well, okay, I can do that, but when I need to tighten the belt, I have the ability to do that as well. And so at a 30-year, it still makes sense, because you're getting a huge amount of more spending power and a large amount of flexibility, right? Because on the example of a $500,000 house that he was using, well, I mean, the difference is $600 a month, which is pretty big, I would say. And so, again, I really like that he uses the numbers and breaks it down so you can visualize, okay, what is actually happening here? What are the benefits that I'm gaining from a 30 over a 15? And does that make the most sense for me? So again, just the points that I want to make on it right now for when he's talking about the 15 versus the 30.
30-year mortgage is so much less money every single month than a 15-year mortgage, so a 50-year mortgage must be even better, right? Well, that is where most people are 100% wrong. So let's talk about the 50-year mortgage. Over the weekend, Trump tweeted a photo of President Roosevelt on the left, who helped standardize the 30-year mortgage, while on the right, Trump sits with a 50-year mortgage. Initially, my first reaction was, why on earth would this ever be a good idea? Because it makes mathematically zero sense whatsoever. But surprisingly, people seem to be rather excited about it. Like, we already have 140.
And he made this video right after it came out. And it was like one person in the administration that was super hyped about it and no one else. So yes, the initial reaction from the one person was like, oh yeah, this is great. And then pretty much anyone with half a brain came out and was like, no, like this is the worst idea ever. So it has, since he made this video, like I said, he was on the cutting edge when he made it, right? This is like almost immediately after. But since then, yeah, he's actually kind of walked it back a little bit and has probably looking at different options which are equally as mediocre, I guess I'll say, in the fact that they do not address the actual problem, which in my opinion is private equity and foreign buyers in the market. You need to get those out. That'll actually fix the problem. Is that going to happen realistically? Probably not.
4-month car loans and buy now, pay later for Chipotle burritos, so why not extend that to a mortgage to hopefully lower your payments? Even the developer Pulte retweeted this by saying, thanks to President Trump, we are indeed working on the 50.
And this is basically who I'm talking about. Like, Pulte came out and they were glazing it, but basically everyone else was like, nah, bad idea. But yeah, again, he's reacting to that first one. But as soon as people actually got to see it and, okay, let's talk about this, not a lot of people in favor of it.
50-year mortgage, a complete game changer, which for those unaware, Pulte Homes is one of the largest national developers in the United States, having built nearly 1 million homes. So if they offer a 50-year mortgage term, people seem to be in favor of this because they think it'll help them lower their payments. They think they could qualify for a bigger house, and they think it'll help keep the real estate market strong. But mark my words.
And the people who think that are just dumb. They are probably the people who would be applying for a 50-year mortgage because they can't afford anything else and they don't understand how interest or even basic math works. And so, yes, it might seem it's the same people who take out payday loans with like a 26% interest rate, and they don't understand that, no, you're literally never going to be able to pay this off. Because the problem is, if you need to take out a payday loan to begin with, you're not in a good position, and this will only make it worse. Like, not only do you then need to come up with that amount of money to pay it back, but then the interest is just going to keep you basically in a perpetual payment to them forever. Like, that's basically what they're banking on. And so, yeah, the only people who are excited about it are, I'm sorry to say it if you thought it was a good idea, but the dumbest people in society. And or the greediest and the most malicious people. Because the other side of that is, once again, as I was saying, with it being 50 years and basically until you die, well, think about where that leaves you. Like, if you actually think about it, that is the epitome of you will own nothing and be happy. And that is exactly, like, when I hear 50-year mortgage, that was the first thing that popped into my head is, oh yeah, this is the global elites. This is forever renter class. This is exactly what it is. Because if you pass away and then for whatever reason your children aren't able to continue the payments or whatever the situation is, they forget about it, it gets lost in the shuffle, a payment is missed, well then the bank comes in and repossesses it, and then the entire time that you've been paying on it, well guess what? You've only been paying the interest, and there's absolutely no equity that has built up on the house. And that is such a huge problem. Like, it's such an awful program, and that's exactly why I'm so against it, is because it's literally a move into a perpetual renting class. It's literally, you will own nothing and you will be happy. And like, that is such a dystopian future. That is not what I want for myself. That's not what I want for children. That's not what I want for anyone.
It won't. It's a bad idea. Anyone who understands math will agree with me. So as far as the actual numbers behind this and what it actually means for anyone who gets one, here's what you came for. All right, now here's the math that no one is telling you when it comes to the 50-year mortgage. Even though going from a 15-year to a 30-year mortgage will improve your affordability by 34%, which is a lot, going from a 30-year to a 50-year mortgage improves affordability by less than 8%. Yes, you heard that correctly. Getting a 50-year mortgage will make almost no difference whatsoever, except you're going to be taking on way more debt for your entire life.
And this is exactly why, is because I love that he jumps into the numbers. 30+%, that's a huge amount of increased house that you can buy, right? When going from a 15 to a 30-year mortgage. But yeah, adding on 20 years onto the 30, you're only increasing the amount of house you can buy by 8% over that 30-year mortgage. So that's problem number one with it, where you go, okay, I'm barely increasing the amount of house I can actually buy. So keep that in mind, and then we'll break down how much you're actually paying in interest over the life of that loan as well.
And if you don't believe me, here's some of the math. First of all, it's important to mention that overall, the longer of a loan term you get, the higher the interest rate is going to be, because lenders want to be compensated for tying up capital for longer. Like right now, it's 6.125% if you want to get a 30-year fixed rate mortgage, but it's only 5.375% if you want to get a 15-year. So I promise, with a 50-year mortgage, you'll wind up paying closer to 7%.
And the funniest thing about that is, I almost wonder if at some point in the future that doesn't completely invert. Because, so, just went out, purchased a vehicle. It was a Toyota. The thing is with that, if you remember, like, back in the day, right? You used to go in and you would say, oh, I'm paying with cash. And this is for, like, anything big, like a TV, a sofa, a car, anything, right? Appliances. And if you went in and you said, oh, I'm paying with cash, they would give you a discount. Now you go in and you pay with cash. Like, I paid for cash for my vehicle. They charged me $4,000 more because I wasn't financing it. Like, just think about what a disgusting practice that is, that you have to pay $4,000 more for a vehicle just because I'm not financing it through them. And so I wonder if at some point it doesn't actually completely reverse, where, okay, you're going to take out a 15-year loan, you want to shorten the term of that. Well, we want more money over more time, so we're actually going to charge you a higher rate. And then if you want to get the 50-year, that's going to be the lower rate. But because, once again, it's spread out over such a long period of time, you're going to actually pay more through that financing cycle. And oh, by the way, like I laid out, you may lose it because at some point, for whatever reason, you're not able to continue payments on it, and then the bank gets a house and all of the interest that you paid. But I almost wonder, and it'll be so funny to point back to this video and be like, oh yeah, I called it, if it ever happens. It might not, right, because the house is a little bit different. But like I said, large purchases, and especially a vehicle in the situation that I just had, it used to be that you would get discounts if you were paying cash. Now you get penalized for it. Interesting trend?
Because there's significantly more risk. This means if you get a $500,000 loan at 6% fixed for 30 years, your monthly payment's going to be $3,000 a month. But if you think you're about to save a ton of money stretching out your payment to 50 years, well, guess what? At a 7% interest rate for 50 years, your monthly payment's going to drop to, wait a second, $3,008 a month. Wait, it actually gets more expensive? Yes. In fact, even if the interest rate is the exact same on a 50-year mortgage as it is on a 30-year mortgage, which is mathematically impossible, by the way, but just for the sake of the argument, let's just assume that aliens have abducted everybody and we live in an alternate universe where that is the case, your monthly payment would drop from $3,000 down to just $2,632 a month. To put that into perspective,
and like he was saying before, when comparing the 15 to the 30, and looking at, okay, what's the monthly cost? That was a much bigger drop, right? Proportionally. We were talking about $600 per month. So like that's pretty big, right? But in this example, it's almost nothing. Like you're saving a few $100s. It's not like 500 plus, pretty big, right? But yeah, just a few hundred is, again, for the amount of extra time, like you're never going to own your house outright. And so, yeah, it's, once again, this is why I'm watching the video. I love the way he breaks it down and makes the point and shows you that mathematically it makes no sense. So number two is that it doesn't actually reduce the amount you're paying by all that much. Because yes, the interest rate is going to make a huge difference, and over such a long time period, it is outrageous, essentially. Like, it's not actually saving you money. There's a break-even point in there, and there's a reason why it's at 30. Is because that's about the amount of time where, okay, anything past this doesn't really make any sense.
It's basically the equivalent of you saving 10% on your mortgage or being able to qualify for a home that costs 10% more. That is it, for nearly doubling the time it takes to pay off the loan in the first place. And like I said, the realistic savings would be pretty much non-existent because there is no way that they could offer a 50-year mortgage term at the same rate as a 30-year mortgage term, unless it's subsidized by the government or it's just baked into the purchase price. And if they do that, we're all going to end up paying for it in the form of higher prices and probably higher taxes. Not to mention, there is another concern with all of it.
And the other thing about that too, that is very important, is higher prices, not just, through the banking stuff, but also more competition in the market. And yes, this is going to sound callous, but if you have to do a 50-year mortgage to save a few $100s, once again, if you do not have the financial sense, and I said this earlier, if you do not have the financial sense to realize that a 50-year mortgage is an awful idea, and for whatever reason, somehow a 30-year mortgage precluded you from going in, but a 50-year, it works out. I managed to qualify with it. It's going to bring in more people, and it's going to drive the housing prices up. Because, okay, all these people can qualify now, and then what happens? Supply and demand. That's all it is. Unless we're freeing up some of the supply and there's more demand, the prices will just continue to go up. But even then, I don't think it's going to make that big of a difference. Because, as I have said before, well, good luck, saving up. Anyone who needs to look at any sort of 50-year mortgage, good luck saving up a down payment for it. Like, it's completely impossible. Like, you're never going to have even 10%. And so, harsh truth, but I think a truth nonetheless.
This, and that would be investors. Here's the part that nobody talks about. 30-year mortgages are only viable because most people keep their home for about 10 years, and then they sell their home, the loan gets paid back, and then they start the process over again. That is why mortgage rates are so heavily tied to the 10-year treasury yield. Essentially, the two are interchangeable. So when mortgages are bundled together and sold on the secondary market, it gives investors a stable return that they could count on, and it provides more liquidity back into the markets immediately to go and issue more loans. On the other hand, a 50-year loan holds a massive risk to whoever buys and holds on to that loan. Why? Well, here's the math. If you buy a $550,000 home, you put 10% down, and you get a 50-year loan, and then you sell your house 12.
And that's a very good point, because if you think about it, think about 2008, 2009, and this is the biggest problem with it, is if you have something that is such a huge liability like this, that's how 2008, 2009 happened. And so you can't introduce this amount of risk into the market and not think that something awful is going to occur, because it has in the past. And yes, it was a different financing mechanism that caused it, but I think if you're drawing parallels of how risky is this is on the same level as that.
12 years later, because most of your mortgage payment is front-loaded with interest, by the time you go and sell it, you've paid off just $32,000 worth of principal. This means if your home doesn't meaningfully go up in value and you sell for the same price that you paid for it, subtract 6% for closing costs, subtract what you have remaining on your loan, and all of a sudden, you've now got less than you put down to buy the property, all for the risk of owning a property in the first place. Now, even though...
And that's exactly it. That's exactly what I was saying, but like the actual mathematical numbers to back it up, right? Because you're looking at it and you're saying, okay, like I said, there's closing costs, you're paying off the loan, and then also, by the way, repairs, paying another 4% to the realtor. Yeah, the whole thing. Like, you're actually down more than that in actuality. Like, if you actually think about the actual, okay, what am I walking away with? It's even worse than that. And that's what I'm saying is, yeah, if you're not paying it off, And this is, again, in 12 years. So even if you held on to it for significantly longer than that, unless you're making well over the amount that you're being charged every month to put in more equity, and even then it's getting evaporated by all these costs. And so that's where it makes absolutely no sense. Like no one, that's why it's mathematically stupid. It literally, no one should have one of these. And this is even digging in deeper. But just simply adding age at purchase to age when you pay it off, you're paying it off until you die. And even then you're not paid off.
Of owning a property in the first place. Now, even though the reality of your home being worth less 12 years from now is unlikely, it does create a very dangerous scenario where if the market goes down by any amount, you're quickly going to be underwater on your loan. And in the event you can't get more than what you paid for it, you're quickly going to be left with nothing to show for it even after holding your home for more than a decade. This is why lenders inherently need to charge more interest up front, because the loan is riskier, and it's riskier for the buyer to lose money on the deal. In fact, it's also a double negative for banks, because if they give a 50-year loan and interest rates go down, the buyer just refinances. But if interest rates rise, now the bank is stuck with a low-yielding investment for many, many, many decades, and they're going to lose a lot of money on that. That's why.
And here's the thing that I think he kind of discounts, is that it would be more of a giveaway for the banks. Because if you think about it from the bank's perspective, like, okay, yes, if you sell, like I said, you could be upside down on it, and that's what I'm saying, you just walk away. And if banks were to basically factor that into their models, well, then now they have the asset of the house. And yes, they have to pay to fix it up and whatever, but that amount is pretty minuscule. And so what they can do is they basically, it is literally, oh yeah, we're just clawing up all these houses that people have walked away from because they're actually losing money on selling it. And that is something, and I think part of the reason why a lot of people in the market have kind of soured on the idea or took a look at it, even in the banking sector, is like, do they really want to be realtors? Like, that basically would have to be a part of any bank with a mortgage section, right? A section where they're actually doing home loans, which is like any bank, especially the large ones. But yeah, they would have to have an entire realtor division because the amount of times that this would happen, assuming that the house price didn't increase, fairly drastically in that amount of time period. So yeah, again, if that is what happened, there would be a ton of people who just walk away or, whatever. They just, for whatever reason, it gets repossessed or it goes into foreclosure or whatever happens. And so, yeah, when that happens, if banks built that into their model, they would probably be more excited about it. But absolutely, any consumer should not be interested in it whatsoever. But yeah, from a bank's perspective, if I was in charge of a bank, I'd say, oh yeah, great. Because once again, you have a perpetual renter class that they're basically just paying you to live there. And then at some point in time in the future, when, some downturn happens or whatever, well, now guess what? I'm just scooping up all that inventory. Yeah, okay, I'll have, a few realtors on staff or whatever. Okay, go out and resell these houses that we're now gaining control over. But it's an insanely dystopian system. But if I'm being objective and I'm running one of these banks, I'm all for it. Absolutely. That sounds like a great deal. Tell me where that's a bad deal for me. And again, I think he's kind of downplaying that possibility, but I think it's a very realistic reality that I don't know why banks, yes, okay, there's risk and blah, 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 whatever along with it, but all they have to do is repossess the house and, there it is. What does it actually matter? So he is a little bit more on the side of thinking that the banks would be adverse, because I'm not certain that he's thinking through the full life cycle of how this would play out.
Feasibly, a 50-year mortgage just doesn't make any sense for anybody. Not the banks, not the borrower, not the investor. The reason a 15 to 30-year mortgage works so well is because that increases affordability by 34%. But once you go beyond 30 years, there are diminishing returns, and the net benefit for going from 30 to 50 years just isn't there. It's not practical. Not to mention, banks probably don't want to issue loans that you're not going to be alive for by the time you should be paying it off. Unless, of course, it's subsidized for the government or baked into the selling price, at which point, again, we got bigger problems. Plus, on top of all of that, by law.
And that's exactly what I'm saying. Is like, what? Does your family take it over? But no one lives to see that completely paid off. Literally no one. Like, you could get run over by a bus or something when you're like 65, right? On the day of your retirement. And it's like, okay, now what? Like, what are we doing here? This isn't working out. And so, yeah, when you're looking at this kind of stuff, that's the thing is, again, simple addition, it doesn't make sense.
A qualified mortgage is not allowed to exceed a 30-year term. These qualified mortgages are very important because it gives the lender recourse in the event the borrower defaults on their loan. And because those loans are less risky, they're able to charge less interest to the borrower. On the other hand, a non-qualified mortgage does not have that shield, and the liability falls back on the bank in the event the borrower stops paying. That's why I'm saying there's no reasonable way that you can offer a 50-year mortgage at the same interest.
Well, and I imagine if they were going to put in a 50-year mortgage, right, if the administration was going to greenlight it, they would change that completely. It's just like anything else. Whenever they do something that looks good for a consumer, which this doesn't even, but whenever they're trying to frame it as that, well, guess what? They write in a bunch of stuff on the back end that actually benefits the bank more than it does the borrower, right? The person who's purchasing the house. And so at that point in time, it's like, yeah, of course, they've done this for everything else. Why wouldn't they do this for a 50-year mortgage?
Rate as a 30-year mortgage without paying substantially higher interest up front. It just doesn't make any sense. And at that point, it completely defeats the purpose to begin with, because if you pay more than like 10% higher than you would with a 30-year, you start paying more on the 50 than you would with the 30, even though you're reducing the payments because you pay more interest. It doesn't make any sense. Like, if you want my take on this, if this actually has any chance of passing, it's probably going to be a very specific loan product, issued most likely by developers who could just bake it into the higher purchase price. It is going to be issued on a case-by-case basis, and it's going to require completely changing housing laws to enact mortgage protections on banks. Not to mention, it would need to be assumable by people who want to keep the house in the family, because otherwise you have people taking on 50-year loans just so their kids could keep paying off the loan, and then eventually the kids die and the grandkids hopefully inherit a paid-off house 100 years later. To me, all of this is just a bit of a gimmick. Like, it's fun to think about, it gets people talking a lot on Twitter, but mathematically, it makes no sense to take this over a 30-year mortgage, and there would have to be major hurdles to overcome just to get this out there in the market. Separate from that, I think, in terms of actually making a difference in the housing market, all we need to do is unlock more inventory, and to do that, just requires really three things. First, increase the capital gains exclusion from $500,000 to $1 million for married couples, and then increase it every year with CPI. This will incentivize way more sellers to list their homes for sale. And that would have been the inflation-adjusted amount anyway from the $500,000 that was enacted back in the 1990s. Second, they should also allow you to take your existing mortgage with you and apply it to the next home, assuming you're trading up on a primary residence. And this would also unlock a lot of lower-priced inventory. And three.
So really quick, just on those two. Number one, so. I think, yes, because of the housing prices having run up, yes. Because if you look in any, even suburban, right, but like in a large city, almost everything is like $1 million, right? 750, 8, 9, $1 million, like anything nice is that. And so, yes, that would incentivize more people to actually sell their houses, right? So, yes, kind of, but I don't think that actually addresses the problem, right? Number two, yes, I think would address, okay, people actually willing to leave because, okay, I can take it with me. So if I have a low rate, because right now, a lot of the problem is people have these low rates. And so, okay, am I going to go somewhere else and buy something else? Yes, maybe, but even if I do that, I'm going to still own this house, and then I'm going to turn it into some sort of rental, be it a short-term rental or a long-term rental, because Airbnb and other companies like it have made that a possibility, a very easy to do possibility. And then, okay, this other house that I used to live in is now an income earning property instead of just something that I'm kind of sitting on my hands and, is a potential liability for me. No, well, okay, now it's bringing me in more money. So, of course, I'm not going to sell. Like, why would I do that? But yeah, that's my thought on the first two that he has mentioned so far.
We should allow people to write off up to $1.5 million of mortgage interest, but only for new loans that are issued after 2026. But beyond that, let me make this very clear. A 50-year mortgage is a very dumb idea.
I've said it prior to, but I think the real ones are, number one, ban private equity. Here's my three. Number one, ban private equity from buying single-family houses. Number two, ban any foreign entity. If you are not a citizen of the United States, you are not allowed to own any land in the United States. And number three, get rid of short-term, basically anyone owning short-term rentals at all. Because build more hotels. I don't know what to tell you. Build villa-style hotels. I don't know what to tell you. Like, just... There should not be like people, because again, it's an incentive thing, right? Like if I can go and I can purchase a house, or if I move out, again, the exact example that I just gave you. If I move out and I go to a different, buy a new house, and then, oh, hey, my previous residence, I have it a great loan amount. And so because I bought it before prices went up and this, that, and the other, well, now I can charge, this rate, and I can make money off the property. And it's the same thing as private equity owning it is, okay, well, now people can turn these into rentals and you're locking up supply. The only way to solve this, there's a reason why all three of my solutions are all supply oriented. It's all like his are as well, but not as directly dealing with the problem. It's something like 25% of all single family houses are owned by private equity. Yeah. What are we doing here? And then, oh, by the way, look at any sort of Airbnb and all the houses in your area. Those are all things that could be houses that families could live in, but they're all being purchased up and flipped a lot by private equity, but they're all being flipped into short-term rentals because that is making them more money. They're using that supply of inventory as a money-making method. And by doing that, you're reducing the amount of supply available. And so, yes, that is what is actually destroying the entire market.
It mathematically doesn't make any sense to take. I think it won't even work. It's not going to make any difference for housing affordability. And if people actually go for it, we have a problem, especially when the average home buyer is 40 years old. I guess they just pay for their home until they're 90? Great, just in time to go to the nursing home when their kids could qualify for a 100-year mortgage.
I just threw it into ChatGPT so you can take a look at it. But if you were to actually look at this summary table, okay, if you're doing, again, I put in a $500,000 home, right? So if you're $500,000, what you're looking at here, and again, this is just the breakdown that I wanted to provide because I think this is a good thing as well to look at what you're actually paying over the life of that mortgage. So on a 30-year mortgage at 6% interest rate, which is generous in today's market, but if you're looking at it, your monthly payment is essentially $3,000, and then the interest that you pay. So on a $500,000 house, the interest that you're paying is $579,190.95. So you're essentially paying $1 million and some change. Versus a 50-year, you're paying $366 less per month. However, over the term, so that extra 20 years adds on an extra $500,000. So instead of paying basically 2 times the cost of the house in a 30-year loan, what you're instead doing in a 50-year loan, for those 20 extra years, you're paying an additional third on top of that. So you're paying over $1 million in your total interest. So your total paid is over $1.5 million. And that's why I'm saying what is so important to understand here is just the interest alone on it. Like, you're paying such an astronomical amount of more money into the bank for literally a $350 reduction in payment per month and only an 8% increase in how much house you can actually afford. And so when you are looking at this, yeah, mathematically, it makes literally no sense whatsoever. And again, a $500,000 house in a popular city, like a rural-ish city area, $500,000 isn't even it. So as you increase the price, these numbers get even more out of whack. And so that is 100% why I just want to pull it up here and show you that as well. Is it's not just, it doesn't make sense from, okay, I'm purchasing it and what am I paying, but how much interest you're paying to the bank. I just don't know how you can look at it and think that this is a good move at all. But that was about what I wanted to cover. Again, I thought it was absolutely a joke when they said the 50-year mortgage. My first thought on it was, what the heck are we even talking about? I'm glad that that seems to be the general sentiment in the market. But if you're watching this and you thought 50-year mortgage was even remotely a good idea, hopefully you watch this video. Those facts back it up. It is the worst idea possible. I think it's bad for a whole litany of reasons, but I wanted to make this video just to go, take a more in-depth look at it, because it is something that I think is important to understand, right? If you don't really get the concept of interest rates and housing and how these things that may seem innocuous or not that big of a deal actually make a huge difference in the amount of money that you're paying to the bank. Just, again, wanted to kind of call it out and give you a better idea of what it actually looks like when you're talking about 30 versus 50 years. Plus, I did want to, jokingly, I wanted to cover this video because I think Graham is possibly the only person on the internet who talks more with his hands than I do. So, yeah, just funny. But if you like the video, give it a thumbs up. If you'd like to see more content like this from me, give me a subscription down below. That really will help my channel grow. And if you have made it this far, thank you so much for watching, and I will see you in the next one.